Famous economist John Maynard Keynes once said, "The hardest thing in the world to understand is the purchasing power of money. Purchasing power is often referred to as the real value of money." Another word we often hear about is inflation. For instance, this morning on my way to work, I drove by the local gas station and noticed that a gallon of gasoline now costs over $4. Ouch. By definition, inflation is the general increase in prices over time. It causes the purchasing power of money that Keynes referenced in his quote to decrease. Barron's once asked financial researcher and author William Bengen, the creator of the 4% rule, to figure out the worst time to retire over the last 100 years. Most people would have guessed 1929. Stocks collapsed and the recovery was slow. But that wasn't the worst moment. The answer is 1968. Stocks didn't crash overnight, but they struggled for years. And while markets stagnated, inflation surged. Rising prices quietly ate away at the purchasing power year after year. That combination of a long, grinding bear market and high inflation did more damage to retirees' financial plans than even the Great Depression. Because when inflation runs hot, it doesn't just hurt returns, it changes what your money can actually do for you. And that's why inflation may be one of the most underestimated risks in any financial plan. Today, we're going to tackle that concern head on. You can't control inflation, but you can control how prepared you are for it. Joining me in a few minutes is Foster Group advisor Ben Berger. Whether retirement is years away or already here, this conversation is about one thing: protecting your purchasing power and preserving your lifestyle for the long run. I'm excited about this conversation with Ben. He's going to show you how advisors at Foster Group account for inflation in a plan with a demonstration of the planning software we use. I won't spoil the ending, but you might be surprised by the outcome, especially in light of how much attention this topic gets. But before we get started, I want to show you a few slides to better explain what can be a complex topic. As I mentioned earlier, inflation is the general rise in prices over time. It's often measured with the year-over-year rise in CPI or the Consumer Price Index. A low, stable rate of inflation, typically around 2%, is often considered a sign of a healthy, growing economy. This is also one of the two indicators the Fed focuses on when setting interest rates for our country. The other is employment. The next chart shows the impact of inflation on the real value of a $10 bill from 1983 to 2026. If you hold on to that $10 and do nothing, your $10 from 1983 doesn't go very far today. It's like having just $3 in your pocket. That doesn't feel great. So what can we do about it? Well, there are multiple options, but equity markets are typically considered an inflation hedge. The last chart from each day, before we get to more exciting things with Ben, is the historical difference between putting cash under the mattress, like that $10 bill I just showed you, versus investing in the S&P 500. $100 in 1950 would have covered an entire month of groceries. Today, that $100 might only cover less than a week of groceries for that same family, whereas the same $100 could have been worth $2,992 had you invested it in the S&P 500. The historical average return on the market has been greater than that of the rate of inflation through time. That is one way to maintain the purchasing power Keynes mentioned. All right, now that we've gotten a few definitions out of the way, let's get into it. Ben, it's so great to have you in the studio.
Thanks for having me. It's good to be here.
Yeah, so when you have a couple come in and they want to talk to you about a plan and they have concerns, maybe such as inflation, what guidance can you give them?
Yeah, so the first thing I would do if somebody came in and they had a concern is I would try and dig into it a little more and understand, is there something deeper there? So inflation is a good example. If somebody came in and they were concerned about inflation, the question they might really be asking is, if inflation is higher than I thought it was going to be, am I going to be able to live the life I want to live in retirement? So if I can find that deeper question, that helps me address it better for the client. So in that case, I might bring up a slide like this one. It shows the retirement equation here. And there's multiple different pieces in retirement, obviously, but this is really focused on the financial side. So first off, there's things that are totally out of our control that we really can't do anything about that have a big impact on retirement. Those examples would be market returns, or policy around taxation, savings, or benefits. Again, a meaningful impact on retirement, but there's really nothing as an individual investor that we can do to impact that.
So you just have to manage these, right?
Right, exactly.
Yeah.
And now there's other things that we have some control over, but not total control. These would be things like our longevity or our ability to earn a wage, how much we earn, and how long we work. Again, we have some control over those, but not total control. And then there's this third bucket that we do have total control over. Things like where we invest our money and how we invest it, and then how we save and spend, both while we're earning money and in retirement. We have total control over these, and so my goal is to shift clients from focusing on the things where we don't have total control onto the things where we do. And then we can adjust the plan and accommodate the things that are out of our control. If they're not going the way we thought they were going to go, we can focus on the places we have control, and we can make adjustments as we need to.
So it's just pulling the levers that you can in order to get to the finish line.
Yeah, and I think a key part of it is understanding which levers you can pull, and then what impact is that going to have? Because you can't fix everything, but there's a lot of change that you can make, a lot of impact you can have.
So we've talked about the tools. Next step is, how do you model a plan in order to incorporate these different variables?
Yeah, so we have a planning software that we use, and we build a financial plan for every client that we work with. So what I want to do today is go through a sample financial plan. It's for illustrative purposes only. They're not real clients, but I want to give you a feel for what this looks like and feels like for a client. So a bit of background on this sample client here. Their names are Willie and Diddy Planwell. Their ages are 55, and they're planning to work for another 10 years and retire when they're 65. They have, as of today, an investment portfolio of $3.2 million. So that doesn't include their house, their cars, any of those types of things, just the investable dollars. And another key thing about them is that they want to travel the world when they retire. So we've built in an assumption that they're going to spend some extra money right when they retire for 15 years so that they can go see the world and take all the trips they want to take. And the last piece, because we're talking about inflation today, our baseline assumption for inflation is 2.25%. So you'll see that throughout the projection, and we'll talk about how that changes over time.
Great. Well, let's get into it and see what it looks like for the Planwells then.
All right. So this is their financial plan. What this is going to do is it's going to look at their investable assets over time, and it's going to take into account several things. So first off, how much are they continuing to earn while they work? How much are they saving while they're working? Growth on their investments over time, and then how much are they spending when they get into retirement? All of that's factored in here already. And what this is showing is that the growth in those investments will end up to be about $12 million by the time that they reach age 95, which is how far we project out here. So $12 million feels like a lot of money, and it is, but what does that really mean 40 years from now? So we can put that in better context by looking at that in today's dollars. So if we take inflation out of that and look at this more on a purchasing power basis, what this feels like and spends like today, it's more like $5 million by the time they reach age 95.
So still good, but maybe not $12 million good.
Right. And if you think you're going to end up with $12 million and then you see it spends like $5, that feels different than if you just thought you were going to have $12 million and what that spends like today.
Yeah, it's important to just understand how this works into the plan.
Yes, exactly. So this chart is really helpful in decision making, but one of the things it doesn't do well is give us a good idea of what the range of outcomes are as we look towards the future. So I use for that a Monte Carlo summary. Monte Carlo summary is a statistical model that looks at a range of hypothetical outcomes to see what might happen over time. So as a baseline here, if you look at the right side of this picture, we see that range of potential investment outcomes. So they might have as much as $7 million by the time they reach 95, or they might have as little as $1.5 million in today's dollars without inflation in it. The important thing here is the left side of this picture that shows the 93%. What does that mean? That means that 93% of the time, 93 times out of 100, they don't need to live life any differently in order to reach age 95 and still have $1 left. They can spend, on the travel they wanted to, the living expenses they have, they can retire when they wanted to. They can do all of that as we assumed they will. And regardless of what markets are doing, they can still have $1 left over. 7% of the time, on the other side of the coin there, markets are so bad that they need to make some kind of adjustment in order to still have that dollar left by the time they're 95. So as an example, we're talking about inflation today. So as a reminder, our baseline assumption is 2.25% inflation throughout the rest of their lifetime. So what I want to do is see what happens if that's not the case, that changes. So what I did here was I said inflation is going to be 5% for a 10-year period starting the day that they retire. It's really unfortunate timing for them, right? But what if that happens and then it resets to that baseline of 2.25%? And look at the impact on the score. It used to be 93, and now it's 87%. So that means that 13% of the time now, they're going to have to make some adjustment. So that impact from inflation was a detriment to their plan. So back to the slide, we have total control over some things. We don't have any control over inflation, but how do we control the things that we can in order to make up that gap if they want to do that?
So Ben, I know you often get asked the question, how does my plan compare to, potential outcomes or, possibility of success, given your experience with planning? So maybe just comment on that. And then also, you talked about the 5% inflation. If that's the reality, what other options do people have in order to kind of affect the outcome?
Yeah, so first off, for an indicator of a healthy plan, for people at their age and stage in life, I would look for that number, this probability of success, to be somewhere 75, 80% or higher. Mm-hmm. So them with a 93% score is a really good plan. And even after including that shock to inflation where it goes up to 5%, I think they still have a really good plan at 87%. And I don't think they need to feel concerned about their plan moving forward. They may ask the question, though, we like seeing that 93%, or we want a little more security. And so how might we be able to get back there? So I have two things prepared that I would talk to them about. The first one is that they could reduce their travel expenses by half. So they wanted to go see the world, they still can go see the world, but if inflation is higher than they expect, they may feel uncomfortable spending as much money as they planned to spend on travel after they retire. So they have this lever that they can pull in order to reduce their expenses in their plan and bring the score back up. That feels bad in a different way because then they don't get to travel the way they wanted to. It's not just a free lunch, right? There's no such thing, but this does help them get their plan back to where it was before from a financial perspective.
And so beyond reducing the travel expense, are there other options that they would have at their disposal?
Yeah, so you mentioned earlier that equities are a great hedge against inflation over time. So another thing that we could do is we could increase their equity allocation by 10% starting today. Mm-hmm. If they're concerned about inflation in the future, this is a great way for them to add a little more hedge than they currently have against inflation. Now, you see the score went down from 92 to 91%. Seems a little counterintuitive if we're protecting against inflation. But the reason for that is because by adding more equities to their portfolio, they're actually bringing more risk into the plan as well. And so equities have more risk than the fixed income. Over time, they have more potential. If equity markets are really, really bad, which is what we're looking at here, there's more potential for their plan to be hurt worse by that because they have more equities. Now, on the flip side of that, if you look back to the right, you can see that median portfolio value. So before we made that change with the allocation they had before, that value by the time they were 95 is about $3.2 million in today's dollars. When we make that change and we add more equities, that value goes up to $3.7 million. So even though the score goes down a little bit, the median value goes up because their portfolio has a higher expected return over time. And again, that helps them combat the inflation and the detriment to the plan.
Yeah, thanks so much for sharing this today. It's very insightful. We've covered a lot of bases today, from inflation to planning to scenario analysis. I guess the last thing I would ask you is, what advice would you give to someone that is maybe at the beginning of thinking about putting a plan together?
So if you're concerned about your plan at all, or if you're wondering, am I in a good place today, or what might happen in the future, what could my plan look like? I think it's really helpful to get a financial advisor involved. The reason for that is because we can put together a plan like I showed today, and we can look at a range of potential outcomes. We can look at the impact different scenarios may have on the plan and help to make an informed decision. This isn't exactly right. This isn't exactly how the future is going to unfold. And that's okay. It doesn't need to be. It just needs to be informative and help us make a better decision moving forward. And a financial advisor can help you do that.
Great advice. Ben, thanks for joining me in the studio today.
Yeah, thanks for having me. I enjoyed being here.
Absolutely. I think the common thread we've heard today is pretty clear. Don't rely on guesswork. Plan early, diversify your income, stay flexible, and revisit the strategy as circumstances change. Retirement isn't just about stopping work. It's about maintaining the lifestyle you work so hard to build. Inflation is one of the biggest threats to that goal, but with the right planning, it's manageable. And as always, if you have any other topics you'd like to see us address, please let us know at our website, fostergrp.com. Thanks for joining us today.